Everyone should be connected. If you can see the projection, then that's a good thing. I just want to make sure that the sound quality is great. And while I'm doing the sound check, may I say, Ruth, I hope you're prepared. I hope this doesn't dump tons of rain on you up there. And I hope you guys, you and Jim are safe. And then I know we had a mentoring session here. Dale and Haley, I'm not sure if you're in Colorado or in St. Croix, but if you're in St. Croix, man, I think you escaped or dodged a bullet with that other one coming. The Atlantic seems in the Caribbean, they're just firing off, boom, rapid fire. It's almost like looking at an algorithm generated trading system for hurricanes out here this year, right? So anyway, I think 5 to 8 inches of rain is a big one. I mean, that's a lot of rain in a little period of time. So we hope that blows through and just moves on out. Hemorrhoidus interruptus, the name of these hurricanes. That's the official name. Anyway, thank you all for joining us today. We're going to begin, now that we've gotten the sound checks out of the way and the visualization out of the way. I'm really excited about today's presentation. Many of you are current clients with what's called the Person Algo Optimizer, which we created, but then we kind of put some more steroidal things and thought process in it, and we're going to share a little bit about that today. Just to get house cleaning out of the way, for those that have the Algo Optimizer, as we promised, any upgrade or any changes, you would have free upgrades and free changes. And we promised that the Algo 17 would be in your possession, and that is, it will be started to be, all your ELD files will be sent out to you this week for sure. So that's the good news. So now that we got that out of the way, let's begin. I started we've got the autopilot's going. We're recording, and boy, what a great time to be a trader. It really is an amazing time to be a trader. I hope everyone, at least if you, it's been a very tricky market, so let's just remember that trading involves risk of loss, and there's always no, I love this because past performance is not indicative of future results. Sometimes it's better, sometimes it's worse, but that's why it's not indicative of future results. But patterns, it's kind of funny, can and do repeat themselves. And we had a great little summer school session about getting people to know their trading plan, to know their pattern, to trade what their favorite setups are and those recurring patterns. So, but I'm by law required to let everyone know that trading involves risk of loss. And so let's, with that said, take a moment to read this through and we will continue. All right. So I wanted to start off with, as a trader, I had the opportunity to present to a small investor group in my home little town here, 4 miles from my house. It's in a small investor group that meets. And the irony is, mostly these people were doing options, and not many of them were having a good time. They said that this was a very, very difficult year, lots of drawdowns, lots of losers, keep continuously rolling out. One gentleman asked me, I've been rolling out this Netflix position, I've been losing on it, and I keep rolling it out. What should I do? And I just simply stated, when you're in a loser, you have 3 choices: get out, double up, or spread them off. And my best choice that I was always taught, get out. It's draining you emotionally. When someone says that they're in an option trade and they say, oh, you can repair that, it's not really repairing anything. You're just getting into the same trade again and buying some more time, hoping to recover your losses. But when you do it 2 and 3, 4 times, you're not recovering losses. You're just doing the same trade, expecting different results. So this has been a very difficult time, I think, for a lot of different option traders, is the feedback I've been getting. And I got to let you know, it has been an interesting market, without a doubt. A lot of correlations have broken down, and correlations such as dollar strength, gold weakness, we get that, but then crude oil rallies, a dollar-denominated product. Treasury bonds wouldn't break, and then all of a sudden they did. Stocks and bonds were in tandem, and now they've kind of decoupled slightly. We haven't seen that great departure that everyone's been waiting for the Treasury bonds to crash back down to levels before quantitative easing. Remember, Treasury bonds were never at 142, gang. Treasury bond futures were like at 108. So before Ben Bernanke initiated quantitative easing, and before, when interest rates were darn next to negative, not just zero, but real rates were negative, it's kind of interesting in the sense that we haven't seen that decoupling effect from bonds all into stocks. Remember, that was big talk. But I think for traders, a lot of times we miss market moves. You know, you want to get in, and then you miss the bid, you place a limit order, or the market just keeps tapping down that level, and you miss the bid, and the market takes off with you. That's a big frustration for a lot of traders. Or the markets are flat for hours, and then the minute you walk away, the trade you've been waiting for triggers, and then you're not in. That's a big one too, right? And that has happened. We had a really exciting week between yesterday and today in crude oil, and I mean, I'll go through some of that with you today, but I think a lot of people miss the opportunity because they're looking to get in. They place a limit order, and if you take a market order, it can be very dangerous. So a lot of times what also happens, and I think this is a big one here, traders get in, they get stopped out, they get again, they get in again, and they get stopped out, and then they quit. They said, I've had enough of this. You know, a lot of great trades come because we have to do what's called probing. You know, you get in and you get stopped out. You get in and then you get stopped out. And then, you know, look at the dynamics of the setup. And then, by the way, X is the old connotation or symbiology for a stop, right? So, and this is just me putting a hashtag about selling. So you get short, the market zings back up, stops out, does it again. After getting slapped in the face a couple times, nobody wants that, right? So, or you get into an option trade, it expires, it goes against you. You know, you can't be frustrated. You have to reevaluate what you're trading, and maybe it's just the market conditions. And so if that's the case, there's a couple things that we can address today to help. One really simple answer is pare back your position sizing, and then you have an idea of what your typical risk is, but you need information for that. What is the typical trade result? If you get short a market, is there characteristics? You know, today we did something in our live trading room on Apple, and I shared with people, Apple typically when it peaks out, it doesn't just go straight up and straight back down, but even this year, and I'm just talking about simple little pullbacks, there's a lot of people betting that Apple's going to peak out, and it could, but it has a consistent tendency of forming secondary higher highs. In other words, something like this. It'll go up, it'll trade down a little bit, go up one more time, and then break down. And so the number 1 point is lower than the number 2 point. We call that, in old school technical analysis, we call that an Arthur Merrill M11 top. The market takes out the number 2 point is higher than the number 1 point. Another thing that comes up with that particular price pattern, by the way, is corresponding volume shows a lower volume reading, and that gives you what we call a bearish divergence pattern. Some people may use an oscillator like stochastics, but whatever indicator you're using, it seems Apple has a tendency of forming secondary higher highs. So we're kind of very curious as to Apple's performance up here. We've been bullish on Apple. We had a great strategy there before earnings with the ratio back spread, and that's another topic for another day. But I think this is a kind of market environment that's getting a little trickier to trade than it ever has before, and I have an explanation for you why. And it's not based on politics. It's based on maybe nervousness in the markets, and it has a lot to do with a lot of traders are not even, and I mean institutions, are behind the 8 ball. They're not even in this market, and it keeps rallying. And I got news for you. If you're a fund manager and your performance is subpar to what the measurement of the S&Ps is at the end of the year, a lot of fund managers risk losing their clientele for others that are doing well, right? I mean, bottom line. But for individual traders, if you've been doing something and it hasn't been working, I mean, let's face it, your confidence is crushed, and then you don't like to take any more risks. And you have to reset. We call that a trader's block scenario. But I know a lot of people get in, they get stopped out, and then their signals say to reverse if you were long, and then you don't, and that's the big winner. I don't know if any of this is something that relates to you, but it will one day if you're a trader. We all have been faced with these types of situations at one point in our life. And that's kind of where algorithm and computer algo trading has been taking over. And I think algorithmic trading has forever given the edge in favor to those who have access to it. You need data mining to help develop a system. You need computer science degrees to help do programming. And you need algorithmic sequences are needed to develop and backtest a system. I think you also need to know that auto execution, stop loss, profit targets, trailing stops, they need to be efficient so that you understand the dynamics of what you're asking your algorithm system to do. Now, I want you to take a good hard look at this screen, because this is actually, this is now our era's new faces of the pros. Here's a few industry experts, and actually this isn't from last year. This is actually some of the folks that will be speaking, headline speakers at a hedge fund conference in New York City in the next couple of weeks. I mean, no offense, these kids are, I mean, these are, to me, and maybe I'm getting too old, but they look like children, and they're advanced in their industry. You know, take a look at the topics that they're experts in. Decentralizing, how badly designed DApps, I don't know if anyone knows what a DApp is, can make quants rich or not worth using at all. Passive investing in a volatile asset class. Look at this. Explicit infrastructure gaps for institutional digital asset managers. This girl looks like she's, to me, in 8th grade. And I mean, you know she's not, but boy, I'll tell you what, that's kind of an interesting component about the people that are behind the quantitative analysts and experts in Wall Street today and in the financial industry. I thought you'd like to see. I think most of us, and I see Gentle John's here, and I met you, and thank you for introducing you again in Chicago at the Traders Expo. Gentle John, I don't want to throw you under the bus, but you're slightly a couple years older than all three of these kids, right? So am I, obviously. But I bet you not one of these industry experts have remembered a housing crash in 08, let alone the flash crash in 10 or any other crash for that matter. And I always say, I think for most traders that are discretionarily trading, how awesome would it be if you had access to a prop firm's trading system, or you had access to optimize a strategy that could be applicable across multiple markets and various time frames, or you knew what the average and above average risks were in a system. As long as your internet was connected, you could probably, if you had some average system to this, you could trade fairly against algo professionals. And here's the deal. You know those faces of the pros I just shared with you? Right now, we now have NYU last year introduced a PhD program for data science, which is not a term that you may have expected out of like Facebook or Google to data mine, a science effect of data mining our buying habits, our living habits, so that they can throw ads at us. But it's also data science is a PhD program at NYU that started last year for quantitative analysts for Wall Street. Harvard and MIT started a master's program this fall for the very first time. And that was why? To meet the needs of Wall Street. I shared this with you, I think, in a presentation a year ago, and I just wanted everyone to know they are actually starting higher level education to teach people how to become data science mining experts for trading algo and developing algo systems. So it's not something that's going away. So the question now begs, if that's what's going on and this is the new trader and the new frontier of trading, do small speculators stand a chance to consistently beat the pros at this game now? I mean, we do think that we have the most advantage over any other time in history of trading, but if you're relying on your computer and signals, execution is going to be an issue, especially for those that are trading futures and maybe exchange traded notes and ETFs and also individual stocks. I think, and I know that people can beat prop traders and institutions at their own games, but I think you need proven tactics to make sound trading decisions, cutting edge technology, and great auto execution. And you need trade system automation skills. And that's one thing that we're going to provide, and I wanted to share this because I'm extremely excited to share with everyone. We have the Person Algo Optimizer, but 8 years ago we started doing this for ourselves. Last year we created the Algo Optimizer, and we continuously did updates and upgrades, and now we came to a product that is just off the charts. I mean, I'm going to just cut to the chase and share with you a couple things here. This is my Tradestation package. I'm going to just share this page with you. This is a trading product called the VXX, and these are, as you can see, we have 1, 2, 3, 4, 5, 6, and baby makes 7 different models on one product. They all have at the bottom of the page, this is closed out equity and this is open trade equity. Every single one, that's your strategy equity. And everyone has kind of little different features. One goes long, one does long and short. This particular one is still short. We have one system, you'll see this one right here. It scaled out of 2/3 of the position, leaving 1/3 on right now. This is probably one of our favorite systems modeling that we use to make trade decisions in a little fund that we've launched with Person Asset Management. I'd like to share this with you a little bit just to give you the idea based on a $100,000 account. It doesn't trade and make you into a rich gazillionaire, but it consistently, look at the consistency in its trades year in and year out. Look at the percent profitability column over here. Let's look at the performance summary just a bit. This one takes short only. It has a 2.17 profit factor, which means its losses are, or its gains are 2.17 times the losses, and 70% of the time its trades are winners. It's only traded 535 times, by the way, in the last 8 years. This goes back, the data goes back since January of 2010. Can systems be better? Sure. Can they be more profitable? Absolutely. At more profit comes what? More risk. But consistency, and whether it's volatility, this is what we're talking about, an algo quant product. And so coming through and looking at different markets, whether it's shorting VXX, long equities, coming up with trade systems. For example, we have a crude oil, which I was telling you guys in the trading room today. We've been looking at a market peak in crude oil yesterday, and I said minutes before the big crash, our big morning briefing this morning was to do what? Turn your algo shorts on, guys. This thing's going down. We had a lot of different reasons for that, and I'm not sure why, how, when, what happened, but man, someone let the cat out of the bag, and that was the big downtrend out of nowhere today. I'd like to share this trade setup. I told you I would in the trading room, and I know we have a lot of clients here right now that were in the trading room. When I made that comment, I said, guys, make sure you turn your algos on short only. Now, one of the things that's interesting, we have a couple proprietary indicators. This is a proprietary volume indicator, and this is on balance volume, which I've trained a lot of people and reintroduced on balance volume. This market, as you can see, was making newer highs. Volume was making lower highs. So we had that little bearish volume divergence on. Regardless, this was a pretty quick trade. If you had walked away for just a couple minutes, the fact that this thing got into the trade and what it's designed to do is scale out at the intended profit target, and then it trails the stop on the balance. A fantastic idea, and this was a pretty big day for us today on crude oil. But that's not what you're here for. What you're here for is this. I've taken the liberty of punching up the E-mini S&Ps, and I wanted to share this with you and show you what's now available. We're going to go up to insert a strategy, and you'll see this Algo 17Xtreme. Why is this different than the original version, the number 3 version? We've had so many different versions because we've back tested, we've created, we've done a lot of things to bring an amazing program. How amazing and what the heck does this thing do? I'm going to share with you a few items. It's no different than the original Person Algo optimizer, except for at the very end. We can begin different sessions. So if you want to trade the open outcry or the pre-market session, if you have access to pre-market session, or if you're a futures trader and you want to trade the European session in Euro currency or futures in the ES, you can select the time, but you can optimize what the best time to start trading and what the best time to stop trading is. So you have 2 different time frames that you can trade. You can trade European session, started at 3 in the morning, ended at 6 in the morning. You could start at 9:40 a.m. Eastern and stop trading at lunchtime and then trade the last hour for trade signals. You could program all of that if you want. Position sizing. You have a position sizing tool. You can put in a position value. I only want to trade $100,000 or $10,000 or $5,000 worth of stock. Figure it out for me, and bang, when I have that signal, throw it in. You can also do it by risk factor. Look at this. If I change this position calc method from 1 to 2, it puts me down to position risk. I can say, put me in as many positions as possible that $1,000 risk. So let's say you're trading a stock and you have a dollar risk or a 40-cent risk. It'll throw you in as many shares as possible that risk factor, it already would automatically calculate, fire it off, and enter the trade for you. Or if you're trading futures and you wanted to do stagnant amount of contracts, position sizes, you can use position calculated method number 3, and it would put in position size. What we like to do is our models use 2 lots. That way we can scale out of half the trade. You can also have a money management function that says, I only want to risk at any one trade a max amount of $500, and I want to take profits at $3,000. Now, these 2 numbers need to be optimized. And you click on this button, and you can say, well, what's the couple things that we would like to know? What's the average true range over the last 10 days? What's the type of profits that you normally get? What's the greatest profit it gets? If the greatest profit is only $1,200, then you would want to insert $1,200, not $3,000. How many losers a day, if you're a day trader, can you withstand? I only want to take 2, 3, 4 trades in a row if they're losers. Stop trading. Something's wrong. The market's bad today. This is a trailing stop function. And there's this scale out function. And I'll cover this in just a second because we released this in the last version called 16. It was amazing. I haven't even gotten to the good stuff yet. If you think this is awesome. Stop loss ticks. Sometimes you need to have a couple ticks if you're trading S&Ps or bonds. If it's a stock, you'd want maybe you need to have 20, 30 cents above a certain risk factor, and you could, guess what? Again, it's optimizable. You can put in whatever the number is that you would like to find out. Should I even have my stops above the determined risk factor? But here's what's really, really off the charts. This is a function called reverse signals. And it's done in 0-1, which means it is done in terms of true-false. If you're long the market and it's a trailing stop and a sell signal comes out, do you want to get out immediately of that long, or do you want to just reverse and go short? Well, that's a topic for another day, but we have that function built in. Who knows? Why not optimize and find out what the most profitable area is? But here's the exciting thing, and I wanted to introduce you to Algo 17. And for those that have Person Algo Optimizer, this is what's coming in your hand. We now, what we decided to do, because I'm sure we've all heard the term, V-bottoms and rounding tops. Tops take longer to form than bottoms. How many people have heard that, right? I mean, the market goes down and straight back up, and sometimes tops take a little while, and when tops do go, when the market goes down, it goes down quick and handsomely, correct? Markets sometimes go up on an escalator, and then they fall off the roof like a falling rock. They don't even take the elevator. So there are different conditions of markets of how they move, right? So if there are different conditions in how a market moves, then shouldn't we be able to optimize and find out if Person's PPS buy signals are any good? Then I want to know, should I take a buy signal, true or false? 0-1 is true or false. What's the risk-reward ratio on a buy signal? And then you can optimize to find out if I'm taking a buy signal on a 5-minute, a 60-minute, an end-of-day, or a weekly. You might find that the risk-reward ratio on a buy signal might be 1.8, and the risk-reward on a sell signal could be 2.5. So you might get more profits on sell signals and have a different risk-reward ratio, but every market's unique, and you have the ability to find and fact and data mine this information by these different variables that we've built. Next, and here's what's exciting. Let me ask you this question. Some of you have Thinkorswim, and you're very familiar with my PPS indicator, which you can run scans. So what helps filter out a good trade and some of the bad trades? If we had something that could filter out a trade, imagine this. Some of you are familiar with what the last conditional change is. But how about if we're going to take a buy signal, do we get better profits if we incorporate a moving average, right? I mean, in other words, if I get a PPS buy signal, the market goes down, and I get a PPS buy signal, would it be better and more relevant if the buy signal is above a breakout or a close of a moving average? Now, the next question is, what moving average? A 2 period, a 5 period, an 8 period, a 20 period? And I don't have that answer. But you know what? If you click on this and you go optimize and you go, let's start with a minimum of a 3-period moving average, and let's find out, maybe we'll go up to 20 and we'll use an increment of 1. And you can hit OK, and then you can optimize that, and it'll tell you for that market, it may not be anything at all. So maybe you could go and change that optimization and say, should I even use a moving average? So you would then put 0 to 20 to 1. That would give you testifiable evidence that maybe you're getting more profits out of your trades or more profitable trades filtering out bad signals when a PPS comes on a particular market. So maybe the E-mini S&Ps, if you're a day trader, or if you're trading spiders, or if you're trading the volatility product, or if you're trading Apple, maybe getting a buy signal, you have a different combination of having confirmed, better filtered trades by optimizing to find out, should I take a buy signal with a moving average confirmation? That's very important numbers. And then again, what is the risk-reward ratio? Is it 1 to 1? Is it 2 to 1? Is it 3 to 1? What is a buy signal in the current market environment if I went and back tested whether it's a 60-minute, a daily, weekly, or monthly chart, right? So you have the ability to individually, single-handedly optimize long positions, whether you're using a risk-reward for that particular buy, using a moving average confirmation, or if you like the last conditional change, you can also incorporate a scan and optimize for that. This is ground-shaking revelation information. We can also break it down for shorts, same way. You can also break it down and decipher the difference between a PPS buy signal and a high closed doji, which is a different patterned buy signal. And you can again break it down individually for low closed doji sell signals. So why would you do this? Why would we create this? Most markets, if you're a long only trader, and for the most part, 70 some odd % of the time stocks go up, so you'd probably want to look for buy only. If you have a product like volatility that after markets maybe break, what do the volatility products do? They go down. So maybe you have a sell only. But you can differentiate between a buy only and a sell only and break it down accordingly and optimize and find out more information on whether your buy signals or your sell signals have different parameter setups for profit targets. That's what makes this, and I think the word says it all in itself. This is taking optimization programming and putting it in a retail trader's hands and giving them institutional and maybe even better institutional grade information that they can act on. That's what takes this all to a new level. Now, we always had this holding period. Sometimes moves take a period of time. Some of us have the patience to wait that trade out. And after a move happens, what's your holding period? Are you sitting around too long? Are you the last guy out at the party at 3 in the morning? Or are you out at the right time at around maybe midnight, 12 o'clock, 1:30 in the morning, right? I mean, you know what I'm talking about. Maybe we've overstayed our welcome. What's the average holding period in a market? Is it 20 bars? Is it 18 bars? Is it on a 60-minute chart? I don't know. Is it 4 bars? But if we take it to 2 from a minimum to maybe up to 30, and then, you can input that. If it's a daily chart, is it 2 months? Is it 3 months? I don't know. Whatever the market is that you're trying to optimize and find your strategy on, you can optimize this. This may be something that is, I'm not going to say overkill, but this puts any type of edge in a trader's pocket he personally wants to have to help beat the quants. And I think more so beats, and I don't know if anyone's seen this, to help you develop a product on any market, any time frame that you have an interest in. By the way, take a look at this last one. Enter trade market order. This is set true or false. This has some proprietary information behind the scenes. And this next one has max bars. And we train you to understand what this is all about. Is it best when you get a buy signal to enter in at the market? Or sometimes is it best, and how many times have we seen a great big tall candle and it gives a great big buy signal and you go, I got to chase that market and get in, and only to find the very next bar goes straight back down and just wipes you out, right? I mean, it's called an equal and maybe opposite, or it even goes even further. Some people call that a tweezer top. If the PPS buy signal was valid, right? If the market gives a higher high and it's supposed to be bullish, if you had a buy signal, shouldn't you see a higher high? So instead of getting in, if the market closes and generates that PPS buy signal and then opens a little bit lower and you go at the market, you're going to get in right there. Well, what if the market doesn't go up? What if the market goes straight back down? Now you just got in a false buy signal. So confirmation can be used by saying, don't enter a trade at the market order. Maybe enter in on a stop in above the high of the entry bar. And that might give you confirmation or added confidence that the buy signal is valid. Doesn't guarantee you'll make money every time. It just says that if the market's supposed to be bullish, then it should do what? Make a higher high, and you're going to go what? With the trend. You and I would be a very hard pressed to take that type of order and have that microscopic, and this is all done. And that's the part of algorithmic order execution. What's better? What's more profitable? Going with the market or stopping in to confirm trades? Because if it's an equal and opposite and you have a stop in entry above the high of the signal bar, you're not going to get in a bad trade. It'll also help filter it out. How many bars do you let that stop work? 1 bar, 2 bar, 3 bar, 5 bars, forever? No. You would optimize to find out what's the highest probability that if the market is supposed to go up and it doesn't stop you in after maybe 2 or 3 bars, just cancel the order. Don't enter a new order. That's the kind of stuff that Algo Xtreme we just put out. Now, everything that I showed you earlier, at least with this BXX system, this is number 1. This is based off of our Algo Optimizer program. Now, I'm not going to get into looking at each and every one, but I'll share one that I think you would probably look at some of these models and say, well, this one's a long, this is a long and short. And one thing I wanted to point out to you, it went long and then it got out quickly and it went short. This one, you can see, this is its closed profit, open trade profit. This went short. This one is short only. It went short, it got stopped out the other day, and it went right back in. Can you imagine being short the market, having a stop, getting stopped out, and not getting back in the market? How many times has that happened to people? But with the Algo Optimizer, if the market has merits, it will get you back into the trade. This one now, even though it had a little drawdown on that one bad trade, it had a small risk, got out, got back in. Look what it did. It provided an incredible trade for you. This is a different model. It's just off the charts, and it just didn't get in a bad trade. It has, but look at the different profits. One's like $1 million, one's 700,000, one's 533, 635, 978. This one's 409. This one's 540. They all have different returns. They're all the same time period. Some of them have, as you will see, around the same entries. Some are a little bit different. You can see this. So using a modeling effect of what is your average models doing? Are they generating the right trades, or is one getting chopped up? Are they getting back in? If you have one system that says it's short, one system was short, got stopped out, one system's definitely still short, didn't get stopped out, the more signals or models that you have that say be short, the more powerful you have information that perhaps you should be short the volatility. And if you're short volatility, and this is just one example of one product, wouldn't you want to be long equities? That's the next subject matter. So we've had a lot of different things in this world and a lot of different markets to trade. And just to point out, here's my day trade page, what we go over. And one of the things that when I look at a day trade, the first thing I look at is advanced decline on S&Ps. And I look at long only. And if I'm strong in my advanced decline, and if my VXX is selling, there ain't no way I want to take any short positions. I want to take long only. I also want to look at my volume, my 60-minute trend. These are the kind of things that I have as a day trader that give me an edge in the market. Same goes for crude oil, and the same goes for gold. So whether gold is a ninny or not, gold's a pretty decent model from long and short perspective. I call it a ninny because it is supposed to be a seasonally strong period of time. And with gold, it's actually, if this is a seasonally strong period of time, and the best that we can get is 1218, when we enter a seasonally weak period of time, boy, we got problems. But I want to make sure if I am trading a product like gold that I not get married to an idea and watch these signals. So, I mean, just from the perspective of whether you take a trade this morning and you can clearly see, or even yesterday, this is what the system's designed to do. Get you in, identify your loss, know what your profit target is, and here's the point about scale outs. This thing will trail the stop until when? That orange is a new stop. It kicks out. So what's the best way to trade? Get in a trade and get out with the profit target, or get in the trade, get out of half the position and trail the stop on the balance? And this particular model suggests it's best to get out at the profit and scale out. But here's the neat thing. I didn't just come up with that idea myself. It was optimized. It's a pretty decent model for trading two lots in a market that hasn't done squat this year, pretty much. But nonetheless, whether you're using it to auto-execute the trades or using it to identify what is the algo optimizer. I think gold's going to go down. Maybe I should sell short. But here's an idea. It actually went long and lost a buck. Oh, boy. But then it got right back into the game and got into the trade and made money. And then the market did this little up and down doohickey and caught the trade. That's hard for a lot of traders to do. You got to admit, many people might not do that. This particular model, short out at the profit target, and it's still holding a short position in gold, which if you're looking for gold to go up and your algo optimizer or your strategy is short gold, especially if you're in long GLD calls, that might help offset your losses there. You'd want to see this thing still long. This is the Algo 17, and the reason we call it Xtreme, because it really does do a phenomenal job of helping you define where your stops are, your risk management. You get to choose your position size based on capital, leverage, or trade per risk, the time in the trade. Now, you can buy systems and you can lease other people's signals, but you never know what's in it, number one. This allows you to create your own trading based off an ETF, ETNs like the volatility product, or spiders or Qs, and or futures. It doesn't limit. You can use the power behind Tradestation. By the way, this is an older slide that shows the equity curve. This particular equity curve was 600,000 when we did this. That same system is up to about 900 and something thousand. So the moral of the story you can clearly see too. This was a while back. We haven't seen the VXX at 41 in a while. But to be able to format and say, you know what, boy, I got a system that says it is short. If this is a product that says to go short, number one, should I be short S&Ps? No. Can you learn this? Sure. If this system says I'm short and it gets out of a trade, would you want to be still long S&Ps? Probably not. So whether you're using it to trade or using it for added confirmation value on your other trades using like markets or inverse related products. So if the VXX goes down, it generally is a sign that the S&Ps or the spiders go up. So check this out. This is part of the analytic process that we have. Another page that we have here in looking at the market. This is the S&P 500. And I know people have struggled this year, and a lot of people are familiar with my work with Person's pivots. I'm just going to show you a couple little analytic tools here. First thing is the analytic tools. These are the PPS buy signals. These are PPS sell signals. This is the advanced decline on the S&P. And as you can see, the trend making what? Higher highs and higher lows. I know our company's called Person's Planet. And at Person's Planet, this ain't bearish, gang. And until the market can actually close below a monthly pivot number. And it came close the other day, but it didn't happen. And the advanced decline was still positivo. This was not a selling opportunity. In fact, I am projecting the market to possibly get up to this next target, a secondary higher high. I think we got a shot at around 294-ish area. We did form today, by the way, and I'll just bring this to your attention, a new high reading in the advanced decline. If you look at that little fuchsia color here, we did perk our head up with a new high, which supports, it's not 100%, but it does support and give added confidence that the market did support against the pivot. It's in now a buy mode. We saw an uptick in volume, and the breadth is positive in the S&P 500. It opens the door, unless something happens tonight, but we're going to close the week out tomorrow. If we live through tomorrow on a higher close, and that generally brings about what? Another follow-through move. So when do we get ultimately bearish? When indicators such as breadth and volume suggest that the market is negative. And then, if that's the case, how many people would want their long S&P trades turned on? Nobody. You'd want a system that could say sell only and only take sell signals and execute that while I'm here, right? That's the name of the game, and I think that gives the individual retail trader the edge in this day and age. You can choose your optimized setting for the time frame you want to trade. You can choose to auto execute, or you can use a confirmation. You can manually select if you want to take the trade or run it without alerts. You can set up strategy positions to alert you of new trades. What I wanted to mention about this is that Xtreme allows us to do just what the other one did. And like I'd mentioned, a lot of systems charge a monthly fee for like $89 to $350 to control your position size. They're like, you know, trade with me and I'm going to sell you my signals, and when I get in the market, you get in the market. You know, maybe they trade 20 times, 30 times a year, who knows? And you can only trade so many contracts. Wouldn't you want to learn how to do this yourself? Because as time goes on, you're going to need to outsmart these algo trader kids and these people that are going through extreme education. What does it take to get an undergrad degree at MIT, let alone what does it take to get a PhD degree at NYU? First, you got to go get an undergrad, you got to get a master's, and then you got to go for your doctorate. What is your salary that a hedge fund is going to hire you at, right? That's what you got to look at. What is the education value that they are going through, that the Wall Street and the quants and the hedge funds are hiring these people? So think of that for a second. How much money is it going to cost for us to want to trade to keep our education up to compete against them? And I'm here to tell you, this is almost institutional grade, if not better. What I think is awesome is the fact that you have the ability to either take both longs and shorts, or just take longs, or just take shorts, and you can find and break down what gives better profits. You know, I mean, what's the holding period on a short? Is a holding period on a short longer than a holding period on a long, right? Wouldn't that be good information to put and give you an edge in the market? The Person Algo Optimizer Xtreme, trading triggers and online trading course, the trading manual, online video instructions, monthly webinars. We constantly give updated monthly webinars, and we have free upgrades, and we promise that. And that's why the folks that you guys that currently have the Algo Optimizer that you bought 17 versions ago, this is the latest and greatest, and it's not quite even an upgrade. It's so different. It's actually a complete new product. And everyone that bought the original Algo Optimizer gets this. You'll have your ELD file. You'll get this product for free. Now, we do have a situation, though, and here's the situation. This is a new product. This is not an inexpensive product. This is for serious traders looking for great information across multiple spectrum of markets. That's a fact. But it's not like getting a PhD degree. And I want to say, and this is a big important point, for anyone that has originally, we promised free upgrades. But because of this product and because of the amount of demand, and anyone that does not, is interested in this, does not have it, that wants something, that's thinking about it, get this before October 1st. Not today, not tomorrow, before October 1st. Otherwise, we will be charging a $500 annual fee for any upgrade. I want to make sure that everyone's crystal clear on this point. Anyone that has it already, you're waived for life. Anyone that does not have it, if you get it before October 1st, it will be waived for life. After October 1st, going into 2019, there is going to be a $500 annual fee for any upgrade if they want it, Otherwise, it is what it is, and that's where it's at. No more free upgrades for anyone that purchases after October 1st. This is also something that we are going to focus on in our 3-day seminar here in November. We're going to be doing a live trading Thursday and Friday with the Algo Optimizer, and Saturday it's down here in Palm Beach, so I don't have to travel, but everyone can come here in the non-hurricane time of year, November after Thanksgiving and in December. So that's what we're going to be doing and discussing how to utilize this for best performance. What's really neat about a seminar like this, guys, is number one, you get to network with other traders. You're going to hear how other traders are doing with this product, and I'm getting tons of great feedback. And I know not just the VXX, but futures traders. And we will get together and sit down at our 3-day investment seminar. So that's one of the things that I wanted to make mention to everyone. If you were interested in that, you should probably find more information about that by visiting our website. And I'm going to go there right now so that you can see where to find both bits of information. For those interested in the event, the seminar in Florida, just go to our home page, and it can be found right here under events, seminar in Florida. Click on it. If you want more information on the indicator, what we need to do is go over here to Algo Optimizer. Right here, Algo Optimizer. And this is where you can find all the information, and of course you can simply call our office and find out all the information you want. There's good news and bad news. It's only available on Tradestation. It's available for the retail public. That's the good news. The bad news is you have to open an account with Tradestation. It's only through Tradestation. So there's two ways to find that product. This seminar, I mean, obviously we're going to talk about Person's pivots. We're going to also, since we use options and use Thinkorswim platform, I'm going to share how the PMC indicator works together with combining better stock identification trades. Many of you may have already been using the PMC indicator. If you're not familiar with that, the PMC indicator is a relative strength tool that helps us to define whether a market is starting to, A, outperform the S&Ps and improve, and give you an idea that you could look at buying a market. This is Starbucks. We were long Starbucks. We scaled out of half the position already, and we've got a tight stop, and I was actually thinking of getting out of Starbucks today. The relative strength started to disimprove against the market. The volume momentum indicator is starting to weaken or show signs of stress here. Let's put it to you that way. That's Starbucks. We just had a nice quick swing trade in Starbucks, and it's up 3.5%, 4%. Nice little trade. But needless to say, the 3-day seminar is definitely something that you're going to want to attend. If you don't even understand about Algo Optimizer, this is it. If you want to know better analytic information, if you want to know about advanced decline, if you want to know about relative strength, specific volume tools, and more importantly, all of that's really combined with why in the heck, if you take a look at crude oil, I want to go over this real quick, okay? So this is crude oil. Let's take a look at crude oil. Remember, some of you guys were in the trading room yesterday, and I said we had this little resistance back up here at the moving averages. We were talking about the market getting up to around that 71.30-40 zone right up in here. Don't get short. Wait for the market to expunge, because we were starting to see my momentum indicator. Now, I want to share this with everyone because I constantly talk about this, and I gave this if you were one of the few people at that Palm Beach investors group. I said that the volume indicator that we created, this is a specialized volume indicator, and many of you that have this, I want you to remind you, this is why it's more powerful than on-balance volume. On-balance volume over the last 2 years has been giving a lot of false or bad signals. And someone had asked me in a seminar a year ago, John, if you're here, I can't see the print, but John M. John M. said, Mr. Person, what do you rely more on, your volume indicator or OBV? And I hands down said, all day long, my volume indicator. It gives clear, concise convergence and divergence patterns in the marketplace. And what makes this a special tool is that the volume is not mirrored in terms of actual net changes of volume. It's actually in terms of percent change. And there's a couple other variables that we created. But clearly you can see that the market made a, from a number 1 point and a number 2 point up here. From this level to this level, it made a higher high up against an older high. But the momentum of the market wasn't breaking out. It was weakening. The volume indicator was making a lower high. If you used on balance volume, you may have gotten the false sense that it was on strong volume in that content. Now, I'm sorry for being the John Madden writer, but here, is this peak high higher than that peak high? Is this peak high lower than that peak high? Corresponding price made from a number 1 to the number 2 point, and the same corresponding levels. Look at that. What tool would rather you have to give you an edge? Should you be looking for this move to expire and maybe burn out and then look for a sell signal? That would be the idea. You guys in the trading room, you know that was our trade yesterday. You know that was our trade yesterday. And so what we were looking for is, don't wait for that Department of Energy or Energy Information Report to come out, but watch for the market is losing its momentum and it's on weakening volume. It's got a divergent situation. And that, my friends, gave a tremendous 2-day return for us in our trading. This is kind of the stuff that we're going to go over in our trading seminar. How to define better analytics in this day and age. I think volume is the lifeblood of the market, but it's not from histogram. And it's now we have less effectiveness out of on-balance volume. I don't have a rational reason for that right now. Years ago when I started to teach and popularize on-balance volume, and many people at Thinkorswim flocked to hearing about it because volume histogram was not giving us a good sense reading of the market. And what do I mean by that? I'll share this with you real quick. We go over here to insert analysis technique on Tradestation, and I'm going to go down to alphabetically and then insert volume. I don't know what this tells me. I mean, in fact, it gave a false sense of security. It showed that the rally was on great volume, right? I mean, does everyone see that? What normally has been happening in stocks, at least, you see the volume histogram goes down and on-balance volume goes up. And that's what it did when I started to popularize and teach and how to use this back in 2009 and 10 and 11. But in the last 3 years, something has changed. I don't know if it's index funds, if it's maybe more dark pool action. I'm not sure. But there is something that is mysteriously working better in this environment, having a more sophisticated tool. I didn't invent volume. I've just invented a different way to read it and help it uncover relative weakness in the market to tell me, should I be chasing that market or waiting for a sell signal? A market that rises and takes out an old high on diminished momentum and weakening volume. And when we get that PPS sell signal, then you can look for breakdowns and sell signals in the market. And that was a pretty darn good trade right there, gang. And that's just our latest that we did in our trade community. And as we identified that, that's why I said, hey guys, turn your algos on to shorts. Turn your shorts. Don't take buy signals. Turn your shorts on. That was a great day, man. It was a great day yesterday. It was a great day today. And the same would go for trading S&Ps. So I think that we can take a look at the market. And when we get together this late November and early December, we will go through how do we collate and find out what does all this stuff mean? Volume, ranges, relative strength with the person's market catcher. What I want to do is I want to look for buy signals that's in stocks or sectors, buy signals in sectors that are firing off relative strength improvement. That's what I'm looking for. And so I think that that's what, at least for individual stocks, that's a part of this and how to put the whole thing together, and we'll be using the Algo Optimizer. So we have an amazing amount of not just research, but tools for the average investor that I think are going to be able to beat the pros. We are doing it. It is achievable. You can do it with the right tools and the right teaching and the right teacher in front of you. No longer do you have to sit there and join misery along others that are maybe suffering. So I think this has been a very tricky market. I'm not going to lie to you. It has been a tricky market. We have a lot of great traders in our community. And, you know, let's just say how tricky has this year been. It's pretty weird when you look at the rate of return on the indices. They're so imbalanced. What do I mean by that? The NYSE, the New York Stock Exchange Composite Index, is negative on the year. Or now it's back positive, excuse me. But I mean, if you think about it, the S&Ps were up for the year 8%, 8.5%. This is up 8.5% and change. This is up, like last week it was up at the highs. This is now back up to about 7, let's call it 18%. The Dow Jones Industrial Average is up 6%. The Russell right now, due to the Russell's little pullback in here, the Russell's something up like 11% this year. And then over here on the NYSE, the New York Stock Exchange, it's up about 1.5%. Can you imagine that? If you're tracking the NYSE, if you're using advanced decline analysis from the NYSE and you're trying to trade S&Ps, if you're using the TRIN, if you're using the McClellan Oscillator, it's giving you a false sense of security. These are what I call very imbalanced percentage moves in a marketplace that's, as dynamic as what we've been seeing between sector rotational grind from one day to the next. And this is why it's so different. It's because of the ability of funds to move billions of dollars from 1 minute to the next with a push of a button. So it is an interesting market. I think you have the capability, the tools, the power to gain an edge in the market. And with the Person Algo 17Xtreme, this is a dynamic tool for those investors who really want to capture an edge and get the right education. That kind of concludes our day today. I wanted to use this seminar to give you guys an introduction to our product, what's happening, and how you guys can look to acquire it or find out more information. And also, if you're interested in coming to our 3-day seminar, this is where you find it. Also, go to personsplanet.com/algo or visit our website, get more information on Algo 17Xtreme. I thank you all very much for attending, and I think that this is something, and so for those that are interested, give us a call. Thank you for attending, and I hope I gave you some insights in the market that benefited you to at least to find out, I mean, just from the very least, to find out the faces of the kids that are in control of new quants studies on Wall Street. With that said, our thoughts and prayers are out to the folks up in the Carolinas that are going to get bombarded by a hemorrhoid interruptus. Everyone else, we'll see you the next time. Thank you all very much.